Thank you for joining us this evening for financial and tax considerations when buying a business. I'm your moderator, Renee Goodnow from the New York Small Business Development Center. Your host this evening is the SUNY Canton Small Business Development Center. And joining us to introduce our presenters and lead things off is Angela Smith, Assistant Director for the SUNY Canton SBDC. With that, Angela, I'll turn things over to you.
Thank you so much, Renee. Good evening, everyone, and welcome to tonight's webinar, Tax and Financial Considerations When Buying a Business. My name is Angela Smith, Assistant Director of the SUNY Canton Small Business Development Center. If you're not familiar with the SBDC, there are 22 campus-based centers across New York State and over 1,000 nationwide. We provide free business counseling to startups, entrepreneurs, and small business owners. Our services are free and made possible by funding that we receive from the U.S. Small Business Administration, New York State, and our host universities. Our host campus is SUNY Canton, and thank you so much, SUNY Canton, for your support. We have two offices that serve the North Country. One is located on the campus of SUNY Canton, and the other one on the campus of Clinton Community College in Plattsburgh. Our whole team of advisors are working, and we are here full-time for you virtually. If you want to find the center closest to you and partner with an advisor, all you have to do is go online to newyorksbdc.org and request your free appointment. So I'm going to say that people that are here tonight are extremely smart people, because you know that it's of the utmost importance to understand tax and financial implications when looking to buy a business, getting started right. It's especially important because, as things are, buyers and sellers start at complete opposite ends when they negotiate what will be most beneficial for them from a tax standpoint. Sellers want to sell you stock, and buyers prefer assets. Sellers want as much goodwill as possible, and buyers want as little as possible, because they know that goodwill is often difficult to finance. So I'm really pleased to bring in the tax experts tonight to help tackle these questions. Mr. Doug Hoffman, CPA, and Dennis Vicenio, my French is kicking in, sorry, business coach with the Hoffman Eellas Group. Doug has been part of many, many transitions, and I think across multiple states even.
Yes.
I know you work all the way into Connecticut, so I knew it was just New York. And you've also worked with buyers and sellers. So again, extremely grateful that you guys are here tonight, especially because we know tax season is in full swing. If you have a question, please type it as we go along. We'd be happy to try and answer your questions during the presentation. And I know Dennis and Doug usually are able to stay back a little bit if some of your questions are not answered during the presentation. So with that being said, let's get rolling. And I'd like to welcome Doug Hoffman. Thank you, Doug, for agreeing to do this presentation. And thank you so much for your support of small business.
Glad to be here, Angela, and thank you for inviting us. We get a lot of pleasure out of helping small businesses, and this is a good vehicle to get the message out there. We want to see people plan ahead and do the right things and not regret what they did without the proper planning. So with that in mind, I want to introduce Dennis. Dennis will get us started today and do the introduction. Angela, do you want to?
Dennis, I just noted that Danny is here with us. Danny, did you want to talk a little bit about the conference? Oh, she's sorry about that, guys.
There she is.
No,
Danny, she's having trouble with her audio. She's not connected yet.
Okay. Well, I think we'll keep going, and maybe we'll take a break, and Danny can talk to us when she's back up and running.
All right. So turn it over to Dennis to get us started here. Dennis.
Yep. Thank you, everybody, for attending. Danny, just jump in. Can we hear you?
Well, I'll actually say something for Danny. Danny works for ENCA. She is the coordinator for the Center for Businesses in Transition. She is the person behind this entire conference, and her team has done an amazing job. So thank you so much, Danny. I know we have some amazing co-sponsors also to thank: Community Bank, Glens Falls National Bank, SBDC. So did I cover your little bit your bases? Good. All right, Dennis and Doug, over to you.
All right.
Okay.
Great. Thanks everybody for attending. Doug, let's get ourselves started here with simple. Who are we? So Doug Hoffman will be our main presenter today, former managing partner at the Hoffman Eellas Group. Doug has 47 years of experience as a CPA, MBA, certified business coach, author, and speaker. He co-founded CFO to Grow, providing financial, marketing, and strategic business consulting and coaching services, as well as virtual part-time CFO, controller, and accounting services. I am Dennis Vicenio. I'm a business coach with 35 years experience assisting small businesses maximize limited resources and achieve financial goals. I've had the unique experience of working in an explosive growth small businesses, and along with some tough times where we've had to make very difficult decisions. I've been a CFO and a controller in many small businesses in the retail, automotive, manufacturing, construction industries. So the goals of the presentation today have give business owners, potential business buyers, some tools and concepts they can use for planning. We do have a disclaimer that says this presentation will contain general tax advice and recommendations. Consult your tax advisors for specific tax guidance related to your specific situation. Information is presented in a generalized manner. Every business has some special considerations when applying these tools and concepts. So we're going to break this down in some parts for you. A buyer's view of the business sale. We'll talk a little bit about researching the market and the industries. And then we're going to jump right into financial statements and tax returns, tax considerations, cash sales versus a note or a mortgage, and buying assets versus stock sales. Having said that, I'm going to turn the rest of this presentation over to Doug and let him kind of lead the way. So take over, Doug.
Okay, we'll start, Dennis, thank you. We'll start with some research that you should be doing if you're looking to buy a business. And the first is, what is the history of the business I am interested in? Is this the right industry for my qualifications? Is the business the right size for me? Jumping back there, everybody thinks that they can jump into a restaurant and flip hamburgers, but there's a lot more to it. And, depending on what industry you want to go into, look under the hood and make sure that it's a good fit for you. Can this business lead to the right lifestyle for me? How long, how much commitment do you have to make to a business? Is it a 24/7 or is it a Monday through Friday? And what do you want for your lifestyle? What resources are needed to make the business successful? And does the purchase price match my funding sources? Are you able to come up with the money for and the financing to buy the business? So those are general researches. I'm sure in the last day or two and tomorrow, you'll be approaching these questions from different perspectives. But it's a good way to get this off and running for this segment on tax and financial considerations. So let's talk about the financial considerations of buying a business. Basically, it's going to come down to show me the money. What's money is going to be generated from this business, and how do you measure that? And generally, it's it's called earnings before interest, taxes, depreciation, and amortization. And you may hear this as you're getting into buying a business. It's called EBITDA, EBITDA, earnings before interest, taxes, depreciation, and amortization. That's where you show the money. How much money will this business that you're looking at generate? And basically, the cash flow from this business is going to help you to pay for the business, or it's going to give you a return on your investment if you're going to invest cash into this business. So let's show you that calculation real quickly here. The EBITDA for this business, we start out with the net income on the financial statements. This example has $190,000. Then we're going to add in the interest that was deducted, $26,000, depreciation expense of $18,000, the amortization of intangibles. You may not be familiar with that, but generally if you buy licenses or goodwill or items that you can't touch, those are intangibles. This particular one had $2,800 in amortizations. And then income taxes paid for both state and federal of $13,200. So their EBITDA was $250,000 in this example. Now, as a buyer, you're going to want to adjust this number to take into consideration in a small business where you have owners that have control over the business. There may be personal expenses in there, and there may be owner's compensation that doesn't relate to market compensation for the job that they're doing. So we add those back in. In this case, there was personal expenses embedded in there of $5,000 that a new buyer would not generally have, necessarily want to have in running the new business. And the owner's compensation is, in this example, was $50,000. So we add that back in, and then we look at what would it cost to replace that owner. And in this particular business, it's $40,000. It is possible to have the number be higher than the number that we added back in. If we found out that the owner's compensation was minimal or didn't match the market compensation that would be required to replace them, it might be $80,000. So it could be a positive or negative number. So in this case, we end up with an adjusted EBITDA of $265,000. Now, what does that number mean? Basically, if you're going to buy this business, that's the return that you're going to get on your investment, assuming that this business is going to chug along and make the same amount of gross income, and operating expenses are going to stay the same once you buy it. You should be able to expect to have $265,000. Now, knowing that, we can get into calculating what the valuation of this business is, because sometimes that is used to generate a business valuation, and that's done by using a capitalization rate for this particular business. Now, a cap rate or a capitalization rate basically will measure what the risk is of buying this business as opposed to starting your business from scratch, or having somebody, in other words, having somebody open a business next to you. What's the chances are of them taking the business away from you, and basically you wouldn't have any business at all. So a low capitalization rate, as you see here at 10%, would generate the highest business valuation because that's the type of business that's going to be very hard to compete against the goodwill and the location and the equipment that it takes to run that business. Normally, you'll see low capitalization rates in hotels, for example, because you just can't open up next door and compete against a hotel without building your own hotel, if that makes sense. But on the other hand, if you're running a pizza business, that could easily be displaced by competition opening up. Basically, for a hotel or for a pizza business, all you need is an oven, maybe a takeout service or some very inexpensive chairs and tables and a pizza oven. So for a very low capitalization, you can compete against a pizza business and within a very short time take all their business away from them or a significant amount. So in that case, we'd use a very high capitalization rate, in this case 25%, and you can see the business valuation, if they're generating a $265,000 adjusted EBITDA, you would only want to pay $1 million for that business. And going a step further, in other words, within 4 years, you'd want to get your money back because that business might not survive more than 4 years. In a hotel business, you may be able to get a repayment within 10 years. And, basically, if you are forced out of business, you still have the building as your investment. So,
Doug, a quick question: when you're doing business valuations, the cap rates, where do you get those percentages from?
well, when you're hiring a business valuator, they're going to have a lot of industry data that's going to help them decide what the capitalization rate is. They're also going to combine that with the local economy and the national economy. Certainly right now with the pandemic going on, hotels may have an entirely different capitalization rate than they had a year ago. Without the pandemic, things were pretty rosy back in December and January of last year. But in March and April and May and June, hotels took on a totally different perspective than they had 3 months before. And even now, with the pandemic still looming over us, it depends on what area you're in as far as the economy, the local economy for hotels. If you're in a major city right now, hotels are suffering. If you're in Lake Placid, New York, hotels are blooming because people can't fly to other destinations and they can drive to Lake Placid and get away from it all. And that's exactly what's been happening.
And just as a quick side note, Doug, because I'm assuming a lot of business owners selling their businesses are not going to talk about cap rates, but they'll often say, hey, my annual cash flow is $265,000 and we multiply that by 3. We hear that a lot, right? Just the industry multipliers.
Yep, we'll be talking about that. That's exactly right. This is only one way of evaluating a business. And it's, there are industry rules of thumbs that you take this EBITDA and multiply it by certain formulas to get valuations. And in theory, they should come out the same. But the point I was making is that a business valuator has a lot of historical and current data and from that, we'll make subjective decisions on how to come up with the capitalization rate.
Great. Thanks, Doug.
Okay, Dennis, any other points, or Angela, that you want to point out before we move on here? Okay, so let's talk about bootstrap financing, an example of this, how you would go to decide how much you would pay for a business. Remember when we talked about the capitalization rate, we came up with these valuations. So if we're talking about the hotel on the left and the pizza restaurant on the right, you want to make sure that if you're going to finance this, that you're going to have enough money to pay the loan payment. So remember, the EBITDA was $265,000. And in each of these examples, you're going to see that you're going to have enough money to pay off that loan after you make a down payment. Now, we use 20% as a down payment in this example because most times that's what the minimum amount that the bank is going to require. And if you're going to do seller financing, the seller is not going to do 100% financing. So they're going to want something down. So in the examples that I have here, I used 20%, and then the balance was financed. And you can see in the hotel example, they're paying this off in 12 years at $239,000. In the mid example, 8 years would pay off that loan at $218,000, again less than the $265,000. And on the pizza or the high risk business, they can pay that off in 5 years at $195,000 and still have money left over on the $265,000 cash flow. So that's what we call bootstrap financing. And that's a good way to prove that the valuation that you're coming up with is realistic. Because certainly if you found out that your payments were more than $265,000, then you're paying a premium for that business that you're going to have to justify some other way. And probably as a buyer, you're not going to pay a premium unless we're going to give you examples of why you would pay a premium as we go along here. Dennis, you want to add anything to this, or?
Yeah, well, I've been involved in a few different buying businesses, and this calculation is critical to make sure that the cash flow makes sense after you buy the business. And from my end of it, that's usually where I've kind of got involved in the dollars and cents in the front side to make sure these numbers really make sense, and then make that part of the negotiation. The more information that you have up front makes it easier to negotiate. And I'm sure Angela will chime in with that one too.
Yeah, and when you work with the SBDC, like, people can ask whatever they want for their business, right? It's their business. Usually they are listed a little bit higher to give room for negotiation. So what we do is we'll do a cash flow exactly like this model with, you know, the debt service, how much you need to take. Maybe you need to take out more money because you're buying the business, but there might be other things, like maybe you need lots of working capital. So there could be other expenses to consider when buying the business. So really what it comes down to, valuation is a starting point, but cash flow is what helps you make decisions whether or not this is a good investment. And you can use a cash flow projection with numbers that are completely upside down. It doesn't work, and go back to the seller and say, look, I would love to give you your asking price, but look, the numbers don't work. We've used that strategy, and it makes the conversation more objective than saying, your price is way too high, right? We're using numbers to say, look, I would love to give you every penny you're asking for, but it doesn't work. Help me out. So cash flow is an excellent tool to kind of start negotiations and use data to have a non-emotional discussion.
Yeah. Yeah, that's the bottom line, Angela, is the cash flow, and forget about the business valuation. Just figure out the cash flow and figure out what that would finance. And that's your own, what I call a napkin valuation. You do it on the back of the napkin while you're sitting in a restaurant, if we ever get back to restaurants. Anyway, that's the bottom line. Show me the money. All right, so here's some other valuations which Angela alluded to. We have rules of thumb in every industry. It's multipliers of the cash flow. You'll see that very often, 2, 3, 5, 6 times, depending on the industry. Industry standards. Sometimes it's just another rule of thumb. CPA firms sell anywhere from 1 times gross revenues to 0.85 to 1.25. Those are industry standards. Discounted cash flow on projected earnings. This is a way, you're probably familiar with this because that's very common in the tech industry. If you look on the stock market, a lot of these high flying tech stocks, they're losing money, but they still sell for ridiculous amount per share. And how do they come up with that? They think, well, they're going to make this amount of money in the future, and we're going to project that back to now. And that's sometimes how you do that. So if you find something in a startup that's going to mushroom or balloon into a real profitable organization, you'll see a discounted cash flow coming up with the projected purchase price. Comparison to other like-kind sales, locally, regionally, and nationally. Remember when I was talking about the business valuator? They have that information at their fingertips. If they're evaluating a hotel or a pizza restaurant, they know something that has sold in your locale or even regionally or nationally that they can project into a like-kind sale. And if real estate is involved, you may have to have a real estate appraisal done because a pizza restaurant sitting in Lake Placid is probably going to sell the real estate part of it for more than if it's out in rural New York, where the real estate prices are much different than Lake Placid, New York. So keep that in mind. You may have to get a realtor involved to do a real estate appraisal. So those are other methods that are involved. Hang on for a minute, my clicker stopped. And
Doug, while you're clicking, projected earnings, that's a tricky business, don't you think, Doug?
Yes, be very wary if you're buying something on hope and a crystal ball.
Right.
That crystal ball might crack. Dennis, you want to get into some of this information on looking at the financial statement and doing their due diligence?
Yep. Thanks, Doug. So well-run businesses generally have good processes in place. So one of the things that you can look at when you're looking at buying a business is that they show you a nice financial statement or a nice profit and loss. It has great EBITDA. But when you start looking under the hood at some of the supporting documents for that, do those documents support the information that you're being given? Where can you find that? So some of the places you can see is, does it have annual reviewed CPA statements? There's a lot of good information that you can get out of those. If you can't, then you can go to somebody who can read the statements and say, hey, it makes sense or it doesn't make sense. Generally, if a company produces monthly management financial statements that they're possibly willing to share with you, that's also a good indication. That means that they have good accounting practices generally in place that they're trying to follow. All the financial information that you're given should tie back to tax returns. So generally, just like a bank sometimes, if you want to see their tax returns, Doug's always said, if it's not on the tax returns, you don't pay for it, right, Doug?
Yeah, exactly. If they say, well, you know, that's what's on the tax return, but I make a lot more, forget it. Walk away.
Walk away.
Want you to pay, but you know, if you're going to buy that business, only pay for what they're reporting, because I've seen people buy businesses and they get in there and guess what? That extra money wasn't there.
Right, right. So, and then as you get into some bigger businesses, if you're buying employees, or shouldn't say buying employees, but if there are employees in there, those are some considerations that you'd want to make. Do all the employees have job descriptions? Is there standard operating procedures written? Do they have checklists? Do they use word tracks? Those are all signs of well-run small businesses. Some have them, some don't, but generally that's worth money. You don't have to come up with that type of strategy, you know, unless you're buying a business that you're really familiar with how to run. Sometimes you need that stuff to help you understand how the business should be run.
Yeah, and as you read at the top of the screen, buyers want to buy a business, not a job. You want that business to be able to run by itself, even if you're going to work in that business, because otherwise you're just buying a job. And you want to expect a return on the investment that you buy. And so, you know, make sure the EBITDA includes owner wages or the adjustment that we talked about before. So absolutely, Dennis, you want standard operating procedures so that, you know, the person sitting in any position in that business can operate that business without you being there. If you have to be there, then you just bought a job.
Well, and sometimes you can see that on an existing business if the owner has to be there all the time, and if the current owner can't get away from the business, a lot of times a lot of that knowledge or a lot of the business that's driving the business is tied right up to the owner, not to the business, you know.
Absolutely. Okay, so keep in mind, cash flow is king. Cash is king. Net cash flow after operating expenses is the key to any business valuation. Check the accounting methods that are used. You know, you can be misled. A cash basis business isn't accounting for all the transactions in that business. It could be better, it could be worse. You have cash, you have accrual. Accrual basis accounts for the receivables, things like receivables, payables, inventory changes, inventory valuation. Then you have tax basis accounting. What's on the tax return may be different than an accrual basis financial statement. And then you have to ask the question, as Dennis pointed out, do these financial statements comply with generally accepted accounting principles? That's called GAAP. And does the balance sheet support the income statement? It's, you know, a lot of people don't even know how to read a balance sheet, maybe not even an income statement. So make sure you have the technical expertise to do that or get professional help to do that. Dennis, you want to add to that?
Yeah, I think what I see a lot in especially in entrepreneurs and small business owners is that they tend to focus very heavily on the income statement, about what their monthly income statement, their annual income statement. And it's interesting to me that when you go to a bank for financing in general, they focus very heavily on your balance sheet. So, you know, I always say, what should you really understand? And you got to understand the whole picture, obviously, but the balance sheet's pretty important. You can't ignore it, right, Doug?
Right, exactly. And if you really want to see what the business is doing, keep in mind the statement of cash flow. Now, most small businesses never produce that. But if you really want to see a roadmap of where they came from and where they went in any particular time, like a month or a year, produce a cash flow statement under generally accepted accounting principles. And that is really the roadmap of how that company operates and where the money came from. Again, show me the money.
Yeah.
That's
Yeah,
where you show the money.
And Angela had brought it up earlier. A lot of times, especially in small businesses, is that not having enough cash or being cash strapped is a very stressful situation, no matter how good the business seems to be. Is that if you're undercapitalized and you don't have enough cash, it can make managing a small business very difficult.
Yeah, you really need to pay attention to that, especially when you get into markets that have seasonal variations. If you have 60 or 70% of your money coming in the summertime and very little in the fall and spring, you're going to have a line of credit or capitalization to carry you through those slow times. And so you want to get down to a monthly cash flow budget. You see what it's going to really take to finance the working capital of this business.
Yeah.
Okay, it looks like Angela wants to weigh in a little bit here.
Okay, go ahead, Angela.
Of course I do. And just one really key factor to understand is when you're looking at buying a seasonal business, your timing of when you want to take it over is super important. So if you're going to buy at the end of the summer, you're going to carry this business probably for 10 months. It's going to require a lot more working capital than if you time it right and hopefully take over, April, May, June, right before the busy season. So we've done some analysis with clients and said, look, if you can't close on this business before the summer, you're best to wait another year before taking it over.
Absolutely, that could be critical. Okay, Dennis or Angela, anything more you want to say before we move on? Time's up. Okay. All right. So other considerations, why would you pay more for a business than the methods that we're talking about? There's a possibility of a strategic purchase. Is there savings by combining resources with an existing business operation you already own? A lot of times, if you already have fixed costs that could be eliminated by combining the two businesses together, you could be much more profitable than the existing cash flow from the business you're buying. So in that sense, you'd want to do a combination to see what savings would be involved and how much that would increase the cash flow of the combined business operations. Are there long-term agreements that just came about, like sales contracts or purchase agreements that can have a valuation, and especially if these are documented and legally binding? Again, that's where you would get into projected earnings versus historical earnings. If something brand new came up in the last year or two, that's going to increase the sales and profitability of this business. The other ideas are elimination of competition, growth that would be more easily purchased rather than done on your own. Acquisition of workforce. In this day and age, if you can get talent by buying a business, it may be worth paying extra for that. Expansion and new products or services. So those are reasons that you might pay a little bit extra, but again, be very, very careful and know what you're doing if you're going to pay more than the cash flow warrants of that business. Dennis, anything you want to add to that?
Let's let Angela weigh in first, and then I'll come in on the backside.
Sure.
I was just going to say, a lot of the conversations we're having this week is about an existing owner being able to mentor or help you learn the business or help you transition into the business. Would that come into play in here where you would potentially pay a premium for that advice, or do you recommend doing that off the books as a consulting fee?
Well, I think it's important in deciding the purchase price, because if you're going to buy a business where the owner is just going to hand the key to you and run, you may want to pay less for that business because you're taking a bigger risk in buying that business. If they're going to stick around and help you for a short period of time or a long period of time, then yes, you may want to pay extra for that, but the extra that you're paying is probably the compensation to that owner to stick around. So that's where you will get into extra price, and whether you build that into the price and justify the price with that extra compensation, or you go over and above, is going to be determined in your subjective valuation of the value of that owner sticking around.
My experience with this has been, it's some good and some bad. So generally, if the business is well run, in my experience, and they have good procedures in place, having an owner help you transition can be good. If there's some level of expertise, and in some smaller businesses that I've been involved in the purchasing or acquisition on, is that a lot of times there's owners of small businesses that haven't been an employee of another business for a very long time in their career. And it can be difficult for that type of person to transition to being part of maybe a bigger organization, or even having to work for somebody else, because if I'm buying the business, it's my business, right? I'm going to make decisions. Now you've got to have a really well thought out agreement with that mentor about how are decisions going to be made. You don't want to get in a situation where, maybe an owner is saying things like, well, I never did it that way, right? But it's your business at that stage. So just be careful about it. I think having good agreements in place and having a well thought out strategy, how you exit from that position, is important, in my opinion.
Mm-hmm. Very good. Good points. Thank you. All right. Here's where we get into projections. And again, be wary if you're going to buy a business based on projected income. Unless they have very unusual situations, don't even think about it. Again, to go over some things that we mentioned before, recent increase in revenues that historical records don't reflect, changes to licensing, trade agreements, or regulations that can be sold with the business, new products just introduced without previous history, and recent market changes that the business is uniquely positioned to act on. Dennis?
Yeah, I think you got to do your homework, and this is one thing about buying a business. Sometimes you can get caught up in the emotion of like, I always wanted to own a restaurant, or I always wanted to own a ski shop in Lake Placid, or I always wanted to have my own auto mechanic deal. Those are things that, you may have an interest in those things, but then having it as part of a business, you got to do your homework and knowing what the market is, knowing a little bit more about the business. This is all stuff that, you want to make sure going in with open eyes, right?
Right. All right, Angela, before we get into tax concerns, do you want to add anything to anything we've talked about?
No, you guys are doing great. Keep us learning.
Okay, we will go. All right, so the main thing I want you to understand here, Dennis, you want to tell them again?
Yep. See your accountant before you decide on a price or consider making an offer. That's critical on both sides of this. You know, there's structure, there's different ways you can structure a deal. They all have different tax ramifications. Understanding a seller's perspective, Doug, I think that helps you as a buyer. If you can understand what the seller's trying to do, it puts you in a better negotiating situation, don't you think, Doug?
Yep, and we'll get into some of those just so that anybody online now will understand those, because that's going to help you negotiate the price.
Yeah. Yep.
And keep in mind that what's positive tax-wise for one could be negative for the other. So, you know, you can kill a deal by the tax negotiations because it's going to have a direct effect.
Or
so
I'm sorry, or
Go
get
ahead.
yourself involved in a deal that seems good on the surface, but if you ignore the tax implications, you're going to create a problem for yourself once you own it.
Right. So it's going to require some good negotiation skills before the deal is done. Don't expect to negotiate the tax considerations after you've made a purchase offer or signed a contract, or after you closed and you find out, you know, that my worst nightmare as a tax accountant is somebody coming in and saying, okay, here's what I did, and it's all done. I'm going, take me outside and shoot me.
There's not a lot of magic that can happen after that, right, Doug?
No. Well, there is, but it's with both hands tied behind the back and weights on my feet.
Yeah.
Okay. And I'm not Houdini. Okay, so first thing that you want to know, and Angela alluded to this in the beginning, is that buyers want to purchase assets and sellers want to sell stock. And generally, guess what? Show me the money. The buyer wins. The buyer has the money. So you're going to win on this first argument unless there's very compelling reasons to buy stock. Forget it. Buy the assets of a corporation or a partnership and start your own corporation because not only from a financial point of view, but from a legal point of view, you don't know what is hidden inside of a corporation as far as potential lawsuits, unrecorded liabilities, tax audits, et cetera, et cetera, et cetera, et cetera. So then keep in mind that there are generally tax implications that are beneficial and harmful to both the buyer and seller on the allocation of the purchase price. So once you do go start buying the assets, again, see your accountant before you allocate the purchase price between the assets that you're buying. Now, as Dennis pointed out, consider the seller's tax strategies that the buyer should be aware of in the negotiations. So a seller is going to want to defer and eliminate taxes. Who wouldn't? That's life. If there's real estate involved, they could do a Section 1031 exchange of real estate tax-free. So they may ask you to allow that to be done, and if that's the case, they'll build in the contract that this gets a little technical, but the seller is going to have to hire a qualified intermediary to sell that real estate to you, and you're going to have to approve that in advance. That you're actually going to transfer the title through that qualified intermediary, but that allows them to take 45 days after the closing to identify up to 2 or 3 replacement properties and 6 months to close on those, and they can defer 100% of the gain by doing that. So that's something that by you accommodating that, it's going to make the seller very happy that he doesn't have to pay taxes on that real estate. They might want to form a charitable remainder trust. And if they do so, they can sell all the assets of that business and not have to pay a dime in taxes. It's very complicated. I won't get into it too much here, but just know that they could eliminate the taxes and they could live off that money for the rest of their lives. And then eventually whatever's left there would go to a charity. It's a very good tax planning tool for some people. This may not affect you or it can affect you, but an ESOP is an employee stock ownership program where they could put in a portion of the sale. They could get tax-free converted into domestic U.S. stocks, tax-free. And that's where you could own, as a buyer, the majority of the company, and the minority interest of the company could go to the employees. Why would you do that? Well, if the employees own part of that business, guess what? They're going to be very highly incentivized to make sure that business is going to survive and be profitable. And again, the seller could walk away with no taxes on that portion that goes into the employee stock ownership program. More importantly, and pay attention to this, you're going to get substantial deductions in funding that ESOP plan. Basically, you're going to get a deduction for any interest and principal involved in paying for that stock that might be financed through a loan that purchased that portion of the business. So again, not to get too detailed here, but let's say you had 40% going into an ESOP, and that was $500,000 the value of the purchase price. Well, you can get bank financing for that $500,000, and as you pay back the interest and principal on that bank financing, guess what? You get an income tax deduction on your tax return for doing that. Not a bad deal. So it's definitely worth considering, and that's why you should know some of these sellers' tax strategies. An installment sale, if the buyer asks the seller to hold a note or a mortgage on the purchase of the business, the seller gets to defer all of the money of that installment note and only pay the tax as you pay the principal back to the seller. So again, they only pay taxes in the year that they get cash. So the down payment they'll pay taxes on in the current year, but all the rest of it will be deferred until you pay back that note or mortgage. And the other thing too is that if they have a C corporation and you're going to buy the assets of that C corporation, under the current tax laws, they have up to 5 years to eliminate the built-in gain. Now, again, I don't want you all to be tax experts, but a C corporation would pay tax twice on a sale of their assets. First, they're going to have the corporate tax, the inside tax, and then once they pay the corporate tax, the liquidation of that corporation or the distribution of that purchase will incur a personal individual tax. So that's the double taxation you get in a sale that way. So in order to eliminate that, they would want to be a sub-S corporation for 5 years to eliminate that built-in gain. That's not your problem, that's their problem, but they may not want to sell it to you for 5 years until they get to that point. So be aware of that. And then this one is a real bonus to everybody, but they don't want to fulfill the IRS requirements to get it, because you have to die to get a step up in basis. But if you're dealing with somebody on their deathbed or with a terminal cancer, they may want to wait until after they die to transfer the ownership of that business to you. So they may want you to run the business for a year or two and then buy it. Just something to consider if you're dealing with somebody that has a terminal illness. They don't pay any tax once they die because they get a step-up basis to fair market value upon their death. I shouldn't say they do, their estate does, and the people that are going to inherit that business can eliminate taxes by waiting until death. Not a nice thing to talk about, but hey, it's there, and it is a tax strategy.
And I think just a quick key takeaway for when you're negotiating, if you're giving in on things that may be advantageous to the seller from a tax perspective, you can split that difference. If it's a tax benefit, and especially with worker cooperative transitions, there are some tax benefits, as Doug mentioned. Well, if they're only getting 100,000 or 600,000 tax relief, maybe some money comes off the sale price. So you can also use these tax advantages for the seller in negotiation to reflect it back into the price.
Yeah, absolutely. If you're going to save them taxes, that's going to increase the amount of money they're going to walk away in this deal. And when you're negotiating, cash is king. Show me the money. All right. So seller will consider, just like I just said, the impact of taxes before agreeing on the sale price, and want to know the net cash that they're going to walk away after taxes. If they're smart. They're the type that's going to walk into their tax accountant after they've done the deal and then find out how much taxes are due. You're dealing with a naive seller. Dennis?
Yeah, that's a big one, I think, in the scheme of the world, is that, knowing what's out there. So
yeah, so again, whether you do an installment sale or all cash up front, may motivate or demotivate a sale. Installment sales, as we talked about, like-kind exchanges on real estate, and charitable remainder trusts. These are all avenues that could save, put more money in the pockets of the seller and make them very happy in negotiating with you. Now let's talk about what's good for the buyer and what's good for the seller, because again, to save money for the seller, they're going to want more of that transaction tax at the capital gains rates versus ordinary income, because ordinary income can be taxed up to 34% for federal and 8% for state. So, that's a 40% bite, where a capital gain can go anywhere from 0 to 20% on the federal, and anywhere from 0 to 8% on the state. So you got about on the top brackets, you got a good 20% spread there that could have a very good effect on you. So furniture, fixtures, and equipment will always be taxed at ordinary rates because furniture, fixtures, and equipment are depreciated. You have to recapture that depreciation at ordinary income tax rates, and very seldom will you sell any furniture and fixtures and equipment for more than you bought it for. if you did, you would get a capital gains, but that's only in theory. In practicality, furniture and fixtures don't appreciate in value unless you're talking about a Caterpillar front end loader or a massive truck that just lasts for 50 years and the market value goes up on the new equipment. But that's very rare. Buildings. Buildings for the seller will have depreciation recapture, which is maximum of 25% tax rate for federal. And then it will have capital gains rate. Buildings for the buyer will have to be depreciated over 39 years, which is the longest depreciation life that you possibly get. So the other thing too is that if you're financing this deal, it's going to be damned if you do and damned if you don't. You're not going to want to put a lot into buildings, but the banker may not want to finance furniture and fixtures or goodwill that we're going to talk about later. So you may be stuck in putting that a larger amount into buildings just to get the financing that you need. Again, where it goes is going to have a big impact on you. So goodwill is the intangible. That's the thing that you can't touch. That's the value of the business because of its location, of the good service that has developed repeat clientele to that business. The owner that's walking away may have a lot of goodwill, and goodwill you can depreciate, or that, remember I was talking amortization, you can write that off over 15 years, which is a lot better than buildings. So for a buyer, we want to get more money into goodwill than we want the building. But again, the banker may prevent you from doing that. The seller is going to want goodwill too, because there's no depreciation recapture unless they amortize goodwill before, and it's all capital gains to them. So they like goodwill. And then you have covenant not to compete. You certainly want to tie the seller into not competing with you, setting up a business right next to you and taking his clients back or customers back. But that's ordinary income to the seller. It's a 15-year write-off to the buyer. So, the seller's not going to want a high amount going into that, but you're going to want enough money going into that to make sure he's not going to be motivated to compete against you. And normally covenant not competes when they if you go to court to contest them, anything more than 2 or 3 years is going to be hard to defend in court. So that's the other issue that you have. There's the legal issue of the covenant not to compete. So from a buyer's perspective, the best thing for you is furniture, fixtures, and equipment. The worst thing for a seller is furniture, fixtures, and equipment. The next best thing for both of you is goodwill. But again, you're going to have the banker to deal with in the buildings. The more that you can put in goodwill, if you're doing your own financing and not going to a bank, keeping that building low again will benefit you again on real estate taxes, because once you do this deal, guess what? The real estate assessor in the area that you're buying this is going to know how much you paid for that building, and they're going to determine whatever you paid for that to be the fair market value and the assessed value, because most assessments, especially in New York State, have to be 100% fair market value. So those are some of the considerations that you have in allocating the purchase price and arm wrestling or mud wrestling as to getting what's best for you. Dennis or Angela, anything you want to add to this?
Nope, you covered it good, Doug.
No. Well, thank you. Okay. And again, I mentioned depreciation recapture for the seller. That's negative for them in the negotiations. But knowing what's good for you and what's good for them will help you in your negotiations. Again, considering capital gains versus ordinary income for the seller and the purchaser versus the seller's tax consequences. So remember, even you as the buyer need to calculate the impact of taxes before allocating the purchase price. Because again, this is going to have a big impact on how much taxes you pay after the purchase and how much you're going to have in net cash flow after the taxes are paid. All right, so in cash versus a seller holding a note, you know, when we're advising sellers, we tell them to be very, very careful on holding a note because it's a very high risk to them. But getting you as a buyer, getting the seller to hold a note can help you finance the deal. So from your point of view, you want the seller to hold a note because you'll probably get more favorable interest rate than the bank would offer, and it's going to be a lot easier for you to finance it through a seller than it is through a bank. But keep in mind, remember what we said, what's good for the buyer may not be good for the seller, and the seller is taking a risk that you could go into that business and not do as well as they did and end up destroying the goodwill of that business or destroying the assets of that business and walking away, and the seller would have nothing to go back to, or you know, even if you did a good job, if they went back, that if they're selling because they wanted to retire, they can't retire if you default on that note. All right, Dennis, I think that's a wrap up. We will have time for questions afterwards. But Dennis, tell them what we're offering people that stuck around to hear us.
Yep. If you stuck around to hear us, everybody who's attending today will get a 2-month membership in our online business academy, especially for some of you new people are thinking about buying a business. This gives you kind of a foundation in good business practices. For the first 10 people, you'll get to sign up for a free copy of Doug's book, Strategies to Grow Your Business. So if you email me, I'll be happy to send you out the information and the link to sign up.
All right, this business academy is online that you can watch anytime, and it will help you build a foundation for your new business that you're buying. Yep. And it'll give you some very, very good strategies to grow this business and make it more and more profitable than what you bought.
Doug and I are giving some upcoming webinars on March 17th, tax expense and planning strategies at 8 a.m. on March 24th. Oops.
Oops, there we go.
Yep. Our 10K challenge, which we will show businesses where they can find hidden cash in their business, $10,000 or more. And then on March 31st, we're going to replay our bookkeeping basics. So again, email me if you're interested in those. I'll send you the links to register for those.
And I know that Danny did join us, and she did want to say a few things about tomorrow and one-on-ones.
Thank you so much. And thanks, guys. This was amazing. Thank you so much to the SBDC folks for putting it all on. If folks are continuing to join us for the conference tomorrow at noon, we'll be having another relocation section about folks who have made the trek to the North Country, if you want to learn more about moving to the region. And at 4 p.m. in the afternoon, we're talking about how to get some of that money to take over a business. So how do you leverage the resources we have in the region to get capital to take over a business. So please join us for those. If you haven't already checked out the businesses that are available that we're highlighting during the week, please do check those out at ownanorthcountrybusiness.com. And if you want to sign up for a one-on-one, if there's a business owner you're excited about meeting and talking to, please do that. They have available appointments tomorrow night and Saturday afternoon.
Dennis and Doug, I'll let you have closing remarks.
All right.
Thanks everybody for attending. I'll kick it off to Doug and let him have the final say here.
Well, thank you, Dennis. Thank you, Renee, Angela, and Danny for having us make this presentation. Our goal is to help businesses thrive in the North Country. And I think we make a good team together to help people get good starts if they're buying a business, and a final hurrah if they're selling a business. So we're all here to help.